So what changed? Why did gold suddenly become the hottest asset on the planet? The first driver is central banks, and this is absolutely critical to understand. In 2025, central banks purchased between 750 and 900 tons of gold. That's above the historical average and represents a fundamental shift in how nations are thinking about reserves. China alone has been buying gold for 18 consecutive months. Emerging market central banks across Asia, the Middle East, and Latin America are loading up. But here's what most people miss. They're not buying gold because they think it's going to make them money. They're buying it because they don't trust the US dollar anymore. Think about what's happened over the last few years. United States froze Russian central bank reserves after the Ukraine invasion. It sent a shockwave through every finance ministry on Earth. If your reserves can be frozen or seized for geopolitical reasons, they're not really reserves, they're hostages. Gold solves this problem. You can't freeze gold. You can't sanction it. You can't print more of it. Most importantly, you can hold it in your own vaults. This is why China is planning to serve as a custodian for foreign sovereign gold reserves. They're building an alternative system where countries can store wealth outside the Western financial architecture. Now, at $4,000 per ounce, you might think central banks would slow down. After all, they need fewer tons to hit their target reserve percentages. But that's not what's happening. JP Morgan expects central banks to continue purchasing 585 tons quarterly through 2026. Why? Because this isn't about portfolio optimization anymore. It's about strategic independence. It's about having assets that can't be weaponized against you. The second major driver is the Federal Reserve and US dollar weakness. Throughout 2025, the Fed cut interest rates multiple times. Every rate cut reduces the opportunity cost of holding gold. Remember, gold pays no yield, no dividends, no interest. So when treasury bonds are paying 5%, gold looks less attractive. But when rates drop and real yields turn negative, suddenly gold becomes one of the few ways to preserve purchasing power. Here's where monetary policy comes into play. In early 2026, markets reacted sharply to signals that future interest rate policy could shift away from aggressive easing. A leadership nomination at the central bank was widely interpreted as a sign that rate cuts might slow down. That single announcement triggered an 8% drop in gold in one day, the sharpest decline in years. Investors saw it as a warning that the era of easy money could be nearing a pause. But there's a deeper issue beneath the surface. The United States is running annual deficits of around $2 trillion, and total debt continues to climb. Interest payments have become one of the largest expenses in the federal budget. To keep this debt manageable, lower interest rates are almost unavoidable. So even if policymakers signal restraint, economic realities may still push policy toward accommodation. An accommodative policy typically leads to a weaker currency, which historically supports higher gold prices. Another major force is global uncertainty, and this trend is accelerating. Over the past year, international tensions have remained elevated across multiple regions. Trade relationships have grown more fragile, supply chains more politicized, and economic blocs more divided. Instead of stability, the global system has become increasingly fragmented and unpredictable. Data from industry research shows that heightened global risk accounted for a meaningful portion of gold's gains last year. And looking ahead, there is little evidence that these pressures will ease. Trade disputes persist, conflicts remain unresolved, and competition over critical resources is intensifying. In moments like these, investors consistently turn to gold because it is not tied to any single country's policies or promises. The final driver is investor demand, and this is where the story becomes especially powerful. In the last quarter of 2025, gold-backed investment funds recorded massive inflows, exceeding even central bank purchases during the same period. Both individual investors and large institutions increased their exposure. The reason is simple. Gold proved it is not just an emergency hedge. It has become a core portfolio asset. Here's the math that most investors underestimate. Gold makes up less than 3% of global financial assets. That's tiny. Analysts have pointed out that even a very small increase in overall portfolio allocation can have an outsized impact on prices. When a market is this small relative to stocks and bonds, even minor shifts in capital can drive major price moves. And once institutions start reallocating, it becomes self-reinforcing. Pension funds see gold outperforming. They add gold. Endowments see gold protecting against volatility. They add gold. Sovereign wealth funds see central banks buying. They add gold. This creates a feedback loop where demand begets more demand. The fifth driver is supply constraints, and this one doesn't get enough attention. Gold mine supply has barely grown in the last decade. Production has plateaued at around 2,500 to 3,500 metric tons per year. There's no supercycle of mining investment coming. Environmental regulations, permitting challenges, and rising production costs all limit how much new gold can come to market. This means that, unlike other commodities, you can't just drill more holes and flood the market when prices rise. Gold supply is relatively inelastic. So when demand surges from central banks and investors simultaneously, there's nowhere for that demand to go except into higher prices. Now let's talk about what the experts are actually predicting for 2026 and beyond, because this is where it gets fascinating. JP Morgan, one of the most influential voices in commodity markets, is calling for $5,000 per ounce by the fourth quarter of 2026 and $5,400 by the end of 2027. They see a long-term potential of $6,000 based on continued central bank buying and ETF inflows. Goldman Sachs recently revised their forecast to $4,900 for end of 2026. Morgan Stanley is at $4,400. UBS is more conservative at $3,500. The consensus across 11 major banks surveyed by the Financial Times is $4,610 for end of 2026. But here's the key. The range spans from $3,500 to $5,400. That's a spread of $1,900, which tells you how uncertain even the experts are. Some independent analysts are even more bullish. Alan Hibbard from Gold Silver expects gold could reach $6,000 to $7,000 in 2026 if conditions align. Investing Haven predicts $5,400 by 2026 and $6,200 by 2030. And there are some truly wild forecasts out there calling for $9,000 or higher, though these are highly speculative. So what are the scenarios we should actually be thinking about? Let me break this down into 4 possibilities. Scenario 1 is the base case, consolidation between $4,000 and $4,500. This happens if macro conditions stay relatively stable. The Fed continues gradual easing, geopolitical risks don't escalate dramatically, central banks keep buying at steady but not accelerating rates. In this scenario, gold trades in a range with periodic volatility but doesn't make dramatic new highs. Probability: about 40 to 50%. Scenario 2 is the moderate bull case, $4,500 to $5,200. This plays out if economic growth slows, but we avoid a severe downturn. The Fed cuts more aggressively than expected, the dollar weakens further. Central bank buying continues at 2025's pace, and we see some geopolitical escalation, but nothing catastrophic. This gives you 10 to 20% gains from current levels. Probability: 30 to 35%. Scenario 3 is the strong bull case, $5,200 to $6,000 or higher. This requires a severe economic downturn, what some analysts call the doom loop. Think major financial market instability, a geopolitical shock like a war or a major conflict, the Fed forced into emergency policy responses, and a mass reallocation to safety across retail and institutional investors. This scenario delivers 20 to 35% gains, but requires genuinely scary developments. Probability: 15 to 20%. Scenario 4 is the bear case, $3,500 to $4,000. This happens if the U.S. economy reaccelerates with strong growth, the Fed holds rates higher for longer, or even raises them. The dollar strengthens significantly, and geopolitical tensions somehow ease dramatically. Trump's policies would need to succeed in reducing uncertainty, and we'd see accelerated profit-taking in gold. This gives you a 10 to 20% decline from current levels. Probability: 10 to 15%. Here's what's critical to understand about these scenarios. The structural factors favoring gold, central bank buying, geopolitical fragmentation, dollar diversification, these aren't going away quickly. Even in the bear case, gold probably doesn't collapse. It just consolidates gains. The base case and bull cases are far more likely than a return to 2023 prices. Oh, but we also need to talk about risks and wildcards, because nothing goes up in a straight line. The recent 8% crash in January 2026 proved that. Gold dropped from 5,608 to around 4,009, 100 hours after the Kevin Warsh Fed chair nomination. Chinese speculators who had been driving momentum suddenly reversed. Profit-taking cascaded. It was a reminder that at elevated prices, volatility increases. Other downside risks include jewelry demand destruction. High gold prices are crushing consumer demand in India and other major jewelry markets. 40% of gold consumption is jewelry. If prices stay elevated, that demand could collapse further, removing a key pillar of support. There's also the risk of recycling supply. When gold hits $4,000 or $5,000, people start selling old jewelry, coins, and other holdings. This secondary supply can overwhelm new demand if it comes too fast. And then there's the cryptocurrency wildcard. Some younger investors view Bitcoin and other cryptos as digital gold. If crypto rallies hard, it could pull some safe haven flows away from physical gold, though the two markets have increasingly diverged. On the upside, wildcards include unexpected geopolitical shocks. A major conflict in the Middle East or Taiwan Strait would send gold soaring. A dollar collapse scenario, unlikely but possible if fiscal discipline completely breaks down, could push gold to unimaginable levels. Or China could expand its program, allowing institutional investors to hold gold, unleashing a wave of new demand from the world's second-largest economy. So what's the bottom line? What should investors actually do with this information? First, recognize that gold in 2026 is not the same asset it was 5 years ago. It's no longer just a hedge or a small diversifier. It's becoming a core portfolio holding as the global monetary system fragments. Central banks have made this clear with their actions. They're treating gold as a primary reserve asset, not a secondary one. Second, volatility is the price of admission. If you can't handle 8% drops in a day, gold at these levels isn't for you. But if you're thinking in years, not weeks, the structural case remains compelling. Most analysts suggest a 5 to 10% portfolio allocation. It's combining physical gold, ETFs, and potentially mining stocks for different risk-return profiles. Third, don't chase rallies. Use weakness to accumulate. Gold just pulled back from 5,600 to around 4,600. That's a potential entry point if you believe in the long-term thesis. Just trying to time the exact bottom is impossible. But buying after sharp corrections historically works better than buying into parabolic moves. Fourth, understand this isn't about getting rich quick. It's about wealth preservation in an increasingly uncertain world. If gold goes to $6,000, that's great. But the real value is what it does during the next financial crisis, the next geopolitical shock, the next moment when everything else in your portfolio is bleeding red. And finally, pay attention to central banks. They're not trading gold. They're not speculating. They're making strategic, multi-decade decisions about the future of money. When China, Russia, India, Turkey, and dozens of other nations are all buying gold simultaneously, they're telling you something about how they see the world evolving. Ignore that signal at your own risk. Gold's rally in 2025 wasn't a fluke. It was a warning shot, signal that the post-World War II monetary order is fracturing, that trust in fiat currencies is eroding, that the old rules about safe assets and risk-free rates don't apply anymore. Whether gold hits $4,000, $5,000, or $6,000 in 2026 almost doesn't matter. What matters is recognizing that we in a new paradigm where hard assets matter more than financial promises. The House of Saud built a dynasty on oil because oil was the choke point everyone needed. Central banks are building a new foundation on gold because gold is the asset no one can control, manipulate, or seize. In a world of infinite currency printing, massive debts, and geopolitical chaos, scarcity wins. And gold is the ultimate scarce asset. If this deep dive into gold's future opened your eyes to what's really happening in global finance, you need to subscribe to Finance Untold. We don't follow the hype, we follow the money. And right now, the money is flowing into gold for reasons that go far deeper than most people realize. Hit that subscribe button and turn on notifications, because next week we're re-exposing how the petrodollar system is quietly unraveling and what it means for your wealth. You won't want to miss it. This is Finance Untold. The stories they don't teach in economics class.